All right, what's going on, everybody? It's Sunday, 10:45 a.m., August 30th. I got Faisal on the call here with me. We got a lot to discuss in the stock market. U.S. equities specifically is our main focus for those of you who are not um, used to our videos. And we have a lot to talk about today regarding tech, how it's gone up so much. Is there going to be a pullback? How the Fed has basically created TINA, which is there is no alternative investment for asset managers, for investors to put money into really anything else. So lots of topics to talk about. We're going to talk about the VIX a little bit. We're going to talk about how the S&P 500 and the VIX have been going up together. The Jerome Powell speech that happened last Thursday. So lots of good stuff. Make sure you pay attention and watch till the end of the video. Hit the thumbs up if you like our content. And let's get started. Welcome, Vassal.
What's up, man? Good to be here. How are you doing?
Fantastic. I got a lot to talk about, and I feel like you have a very unique insight on the market. I know the past week you had some rocky times regarding the tech shorts. So can you sort of unpack, first of all, what happened in the last week in the market, what you did with your positions, and we can go from there.
Yeah. So for those who don't know, I was going into the week really thinking that tech had a real shot to pull back. I started to see a little weakness in Apple as well as Tesla and Amazon, Shopify, just a bunch of the leaders that had driven up the market so much over the past quarter. They were looking just a little bit shaky on the short-term basis, and I decided to take the risk. And even before the breakdowns confirmed, to short stocks like Coop, Roku, Penn is another one, but like that's kind of in the same camp because it's a very overinflated stock, and I think I'll get into that a little bit later. But I kind of shorted those three, as well as XLK, and hoping that we would get some type of pullback in the overextended assets. But my gosh, throughout the week, it was Salesforce, I think on Tuesday or Wednesday, that ended up taking the entire sector, just tech sector, software industries, cybersecurity, and everything. All the high growth tech industries, they all went up in regards to, or in response to what Salesforce did, which they put out some amazing guidance for this year. I will say though, everyone's talking about the guidance for this year and next year being very good. I looked at the 2022 numbers, and they're actually only set to grow from 2021 to 2022 by 3% in earnings, which was a little bit, I was taken back just a little bit. Like, you're growing 22% from this year to next year, and then it's going to be a drop off of 3%. The whole notion that the compression of tech adoption has happened within this quarter that was supposed to span 5 years is still being taken place. And I truly believe that it's going to continue over the next year or so. But just based on the Salesforce estimates, and this is something to keep an eye out on, maybe 2022 is the year that we start to see the effects of that compression in a negative way, whereas the growth rates start to teeter off because so much adoption has happened now over the span of 5 years. That's something to keep an eye out on, as far as when things will start to get revalued and rebalanced for future estimates. But back to my original point, tech kind of had its leaders throughout the week. It had Workday come in, I think, on Friday to put out some very, very good numbers. Both Salesforce and Workday were kind of the undervalued, least extended software stocks, at least on my radar. So I'm not surprised by just how much they moved, because I think they were due to play some catch up. But overall, tech still looked fine. The leadership closed fairly well. I think there are still some pockets that didn't show up, but for the most part, I'm pretty impressed with tech. And I didn't end up reducing any of my short exposure as far as Roku, Penn, or XLK are concerned, but I did end up adding a lot of longs in Humana, Vertex, Allstate, and I believe there was another one. I just primarily centered on reducing my risk to the short side by adding longs in stocks and sectors that were showing me some good stuff technically. And I'm still afraid to own high growth at this point. I'm not maybe next week I'll get some more confirmation, and that's when I start reducing my shorts and high growth. I'll probably add along. I think AYX and Fortinet look good, but so far I have not. I'm still scared to own high growth. Like tech is still overextended and can still pull back in the short term, in my opinion.
So let's recap on some of the things that you said. So Workday, CRM, OKTA, most of these stocks went up quite a bit, and unfortunately, you were stuck in a short position because you said you may have been a little bit early to the trade in the short side. How do you, as a trader, how do you reconcile with the fact that sometimes the market just goes against you, and do you hedge on the other side? Do you cover right away if it goes against your plan? Like, can you explain to our viewers how you go about that process?
Yeah. So coming into this week, I was primarily thinking that the market was going to come down, but I was in a probably around 45% short position. I still had a ton of cash and had around a 15% long position. So I was primarily short, but coming into the week and after digesting all of the performances in tech and the leadership and how everything looks, for me, I still truly believe that the risk reward for shorting tech is going to be very high, even if I got in a little bit early. So for instance, even though the volatility is high now, I think if there's one thing I've learned about the market is that the downside volatility is much more deadlier than the upside. So if I still think things are extended, when we do get that pullback, I'm expecting a very volatile pullback. Now, I'm not going to say these stocks are doomed for a 50% correction, but a 20% correction in a week is not something that's out of my mind, and I think is very real. That could happen because these stocks are very extended, and I think
They are, yeah.
yeah, and as you're seeing, I think this week we got a little bit of hint in the airlines, the bailout sectors as a result of some of the news that came out in regards to Abbott's new testing. I think if you start to see those bailout sectors gain momentum, you may see tech lose a little momentum because, once again, one of the main things that was pushing tech to extremely high valuations was it was the only place that you could get consistently safe earnings and guidance for that concern. But as things start to clear up in the real world, as far as people traveling again and going out and doing their daily habits, which I think is totally related to the testing devices that we're going to get into a little bit later in regards to Abbott. Once that's properly implemented, I think you're going to start to see those companies give out guidance, and that's the most important thing, because a lot of these companies can't even give out guidance. But once they start to do that, and I think the movement that we've seen in the past week may start to indicate that confidence is coming back, you will probably see tech take some type of a break, either consolidate or pull back, like I said. But once again, just some of the ways that I'm looking to mitigate it is trying to still play a little bit of value, but really base it on some of the momentum that I've seen over the past week. So that's how I'm mitigating my risk.
So do you have when you're in a short like that and say the market runs up against you, do you have invalidation levels, or do you still kind of keep your thesis of, okay, the market is overvalued, tech should be looking for a pullback? Like, at what point do you kind of say that, all right, I got to get out, before this thing kind of runs into my profits a little bit deeper, or, cuts me at a very deep loss?
Yeah, that's a really good point. So I'm basing it on a week by week thing. If I had not seen the momentum kind of come in the bailout sectors and everything like that, I would have probably taken some risk off the table in terms of covering some of my ROKU and pretty much all my short exposure. But because I'm starting to see this sort of balance, I have a feeling that not everything can get pushed up if, like I said before, the safety premium kind of disapparates as confidence builds in the bailout sectors. So I'm just kind of going by it week to week. I will reduce exposure if I start to see external factors in the market not align in my favor. But for the most part, I still believe that tech is overextended. And so I'm willing to deal with the volatility, because that's the type of environment we're in. It's just a highly volatile environment. And sometimes things can blow past your technical points in a matter of minutes, like we saw in ROKU. I think was it Friday? Friday, it had opened at like 160 and it went all the way up to 176. Like, that's unbelievable. It didn't even gap up from the open. It actually just moved straight from 160 all the way up. So moves like that were very unprecedented. It just kind of blows past you without even, giving you any warning. I think it kind of blew past my 165 target. Within 2 minutes, I stepped away from the computer. I'm like, holy crap, it's already moving up like crazy. And yeah, I think you have to take it on a week by week basis. But once again, I'm moving up my profit taking levels. I don't expect to make a profit in this stock anymore, but I'm not going to sell it at this high of a loss. And so I'm just kind of using my short-term technicals to figure out a point.
So I'm gonna mention a couple of metrics that are regarding the S&P 500, Tesla, Apple. Basically what's happening in high growth and tech, and then I'm gonna play devil's advocate on the other side too. Okay, so at present moment, the S&P 500 has 22. Is now trading at 20 to 25 times forward earnings. Tesla is trading at 1,100 times trailing earnings. And I think these are 12-month trailing earnings. In August, 40% of the move of the, let me see here, of the Q's index, okay, was guided by Apple in the month of August. So Apple moving up as much as it did in the month of August, it allowed for 40% of weighted movement in the NASDAQ. Apple is currently trading at 38 times earnings and 130 times earnings in its 12-month trailing months. The XLF versus XLK spread has been some of the highest that it's ever been, and it's at 160% spread. So the point of me mentioning all this is I agree with you that high growth tech is extremely overextended, and we should be looking for a pullback in the market. But the point is that has the Fed created an environment, created effectively a bubble, which they are not willing to acknowledge because, first of all, I think they know is true. They have created the TINA, which is there is no alternative investment for money managers, for investors to put their money anywhere else. On top of that, this is my final point, which is I think is borderline conspiracy, theory, is other governments around the world, say Italy, Japan, I forget what other countries, I think Spain as well, their governments, their central banks have effectively disallowed shorting of the markets. I think the Fed is not crazy enough to do that here, but I think they've basically done the same thing with a different, how would you say, tool, which is to flood the market with money to put, keep a put on the market and effectively give investors that backstop. So why should investors right now care about anything regarding numbers where they know that the Fed is doing its bullshit anyway? We know that there's no other place that money can be put in the market. EMs are not performing, right? Emerging markets are not performing. Hedge funds and big institutions are not going out there saying, all right, well, we're going to go to India or Colombia or whatever. We're going to start putting our money in. Why would they do that when they know that there's excessive amounts of money to be made in the U.S. equities market? So that's my spiel, and I want to hear your thoughts on that.
I think to a degree, you're definitely right. And I think that was a big motivator in why the market was going up so much 2 months ago or a month ago, that there was really not another place to put your money in, especially since a lot of the tech companies, at least U.S. tech companies, were still putting out very good guidance and earnings. And that's what we've seen drive up this market from the lows. So I completely get that point that there's not much else that's doing good. Where else are you going to put your money? I think commodities have also been a very hot trade, like gold and silver. But at some point, there has to be some type of profit taking. And I think there has been a lot of money flood into the market. I know that the Fed has created this type of backstop where the risk has really been leveled off in some certain businesses. But for the most part, it's not like you're seeing airlines do well, bailout sectors do well that are primarily that should see the most movement as a result of the Fed putting that put, because they're the ones that are most at risk. So I don't know if it's primarily that or just the overhyping of future earnings. I think that's been the main driver of the market. And at some point that does create some type of overvaluation bubble in these assets. Like I think I don't know if I'd say we're in a bubble in software because like I said, the adoption rate is so high. And I think definitely for the next year, it'll continue to be very high. And who knows what that'll do to the earnings of these companies. But it's hard to say. For me, I primarily want to short this market, short tech, because like I said, the volatility of this market is so attractive. What you've seen on the upside, you can definitely get more so on the downside. But for the most part, I agree. There's not much else, not much real reason to go against this market because you have so many of the risk cleared up.
Yeah. And to add on to my point, you know, you and I spoke about this earlier. I think the market could probably remain even more rational, even more in its bubble-like state, because I personally believe that we definitely have a bubble. Okay, I don't know to the extent of what part of the stage of the bubble we're in, and I wouldn't say it's a market-wide bubble because obviously, you know, you see things like airlines or other commodity stocks or things like, you know, Disney or value sectors that are relatively close to earth. It's really that the tech, and who knows, right? Tech and high growth could be in their bubble 2.0, kind of like we were in the dot-com bubble in the early 2000s. So that's, I think, where I'm saying that, you know, that's where I think the bubble is, and it's still developing, it's still getting bigger and bigger because money cannot go to value right now because there is no value to be generated from society, right? There's not a whole lot of movement. People are not flying as they did. And you may be right. I know you mentioned the whole Abbott testing, and we might be coming to a point in society where, okay, maybe we have some hope of, you know, movement. We have some hope of commodities like oil starting to tick back up again. Those hopes might be there, but is the money flowing there right now? It doesn't seem to be the case. So if the momentum is already in tech, we know that there's a lot of traders already positioned in tech, a lot of banks and institutions and hedge funds positioned in tech. Why should the money flow anywhere else other than just staying here and driving up the price more and more? I think that's where I'm saying that I think we're going to stay in this irrational phase probably till election time, probably till the end of the year.
Yeah, I think like I don't want to paint the market as too irrational because I've said just 2 minutes ago that tech was the main driver of this market. But if you actually look at the transports, the IYT, I think they made an all-time high.
Oh,
Like
really?
Friday. Yeah, I mean, this market has really proven to be one. Like I know UNP, which is the main holding an IYT. No, I guess it hasn't made all-time high yet, but it's very close. UNP, which is the biggest railroad company in America, has made an all-time high. You're seeing different sectors. Nike has made an all-time high as well. You're seeing different leaders in different sectors make all-time highs, and I think it's very narrowing in terms of what's making an all-time high. Like in the industrial sector, you're still having broad industrials, even though they're going to be largely beneficiaries of a lower dollar. They have not really performed as well as something domestic, even though we're still seeing so many problems domestically as a result of, I mean, I guess there was no supply chain problems, but we're still seeing unemployment very high domestically. You're seeing domestic-based companies like railroads do fantastic compared to the multinationals. So there's a lot of different factors affecting this market. And ultimately, I think that's why I continue to remain that even though we will get a pullback in tech, you could still see other sectors move up as, you know, things like the Dow Industrial has yet to make an all-time high. It's still, I think, 1,900 points from its all-time high. You will get to see that movement. And as a result, you may start to see other sectors lose a little bit of steam.
Mm-hmm. Yeah, I think that's a fair point. Let's move on to something that you were talking about earlier. You know, we're talking about the S&P 500 and VIX moving together. First of all, I mean, what do you make of that? And obviously, the prior months to this happening, we had a complete divergence in both. So now that we have the VIX and the S&P 500 together, does that change your mind about anything about maybe volatility might be coming soon, or do you think that the S&P 500 could potentially see, a bit more of a pullback, what you were saying earlier?
No, I really have not paid attention to the VIX as far as gauging the fear or even the volatility of the market. I think the VIX in the short term has been largely pegged to what the NASDAQ does, and specifically what the big tech stocks do. Like if Apple opens down like a good amount, you'll definitely see the VIX spike up versus even if the S&P is kind of flat, you'll see the VIX spike up a little bit. So for future reference, I think people should start to pay attention to how the VIX is tailored more so to the NASDAQ tech versus the Dow or the S&P, because I think that'll be more aligned.
Mm-hmm. Speaking of the fear and sort of greed index, Citi often puts out its model about panic and euphoria. So right now we are currently at one of the highest levels that we've seen in euphoria in the market, probably since the early 2000s, which is, so I think at present moment, someone put up this chart, in the 2000 bubble, the euphoria was way the heck up here around 1.5. Currently, we're right there around like 0.9-ish. So there's obviously still more euphoria to go. This is where I kind of stated my point about I don't think the market has gone complete, bonkers. I think there's still more room to go. It may seem like, okay, these valuations are insane, but wait till you really see the craziness come out. So this is where I kind of am right now. I don't know if you've looked at this chart and what your thoughts are on this.
No, I haven't looked at it, but so far, yeah, just based on that, you could say relative to 2000, there's still a blanket of euphoria left. And I would say that it's so crazy that we see euphoria at these high of levels, but there's still so much doubt in this market, including for people like myself, that there's doubt in terms of valuations. But once again, I think that's going to propel this market to grind higher, whether or not it's secular or broad. That's going to be something to see, but you're totally right. The levels of euphoria, I don't think we've seen anything compared to 2000. I wasn't around trading at that time, but if it's crazier than now, I can't even imagine what that was like.
Yeah. So what else are you looking at for the week ahead, Faisal? What could our viewers be focused on?
So as you know, like I just said, I positioned myself largely in value stocks. I wasn't willing to buy any high growth tech stocks in order to mitigate my short exposure, but stocks like Vertex, VRTX Pharmaceutical, I think is one of the best stocks you can buy in this market. I'm talking, you can get good, actually really good growth for a fair valuation, and it looks like it's just started to bottom out. So this could definitely be a fair price for Vertex. I think this stock is a $400 stock by next year. So definitely keep an eye out on this one. And then I took a shot on PXD. So we were talking a little bit about value and how I was starting to see some of the bailout sectors like the cruises and airlines show me some good short-term technicals right after the Abbott news. So there's a prime catalyst for this type of movement, and it's something that I think could effectively continue the steam that we've seen so far. So another bailout sector, just like I think how you mentioned earlier, you mentioned energy as being in that group that is in value. PXD, Pioneer Resources, has been a top-notch company even before the crash, and I think EOG, PXD, FANG are all great, but PXD has the best bounce back rate for 2021 among the big oil E&Ps. So PXD is one that I think you guys should keep an eye out on if you're someone who likes deep value in oil. And then lastly, I think if I'm going to play high growth, if I get the right signs, it's going to have to be something that's not extended. And I think Fortinet, CyberArk, and AOIX are three names that I'm looking at again, and Datadog, I guess. I think Datadog's a good company. It's just gotten hit fairly bad. But these four companies, I think, are on my watch list for if I end up covering some of my short in Roku and feeling good about high growth. These guys are the ones I'm looking at. So once again, I think value is going to have a great week and tech's going to pull back. But just in case I'm wrong, I got my picks.
What was cyber one?
CYBR.
CyberArk. Okay. Cool. Well, I think we have some good information here in this video. For those who are watching right now, again, we do not provide financial advice. We're here to just talk about the market, how we see it, okay, how we're trading it. If you are interested in joining our Discord, the link is below. We also have a paid side to our membership where Faisal puts out these equities updates every Wednesday and Friday. He does these videos where he talks about his positioning in the market, what he's doing for the specific time in the week. And then, of course, he puts out what stocks he's trading, from growth to the general stock alerts, and then, of course, the options side as well. So hope y'all join our membership, guys. Hit the thumbs up and leave us a comment. Until then, we will catch you guys next Sunday, all right? Cheers.
Peace.